Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, this week felt bigger than just data. There was a legal shock, policy pivots, bond market tension, and even some drama in private credit. Is this one of those inflection point weeks?
It might be. Some weeks are about numbers. This week was about confidence. The Supreme Court ruling against the administration's broad tariff authority wasn't just a legal footnote. It struck at something deeper, the perception of U.S. institutional predictability, and markets care deeply about predictability. On paper, the immediate issue is straightforward. If tariffs were imposed under invalid authority, companies may be owed repayments. Estimates suggest that could be up to $170 billion, roughly 0.6% of GDP. Even if it's staggered or contested, markets immediately do the maths. That's more deficit. That's more issuance. That's more supply hitting the treasury market. And in a market already sensitive to supply, marginal changes matter. But what really unsettled investors wasn't just the legal ruling, it was the response. Within hours, we saw a universal 10% tariff announced under alternative authority, then 15%, then clarifications about honoring bilateral trade agreements. The numbers matter, yes, but the signaling matters more. For decades, U.S. exceptionalism wasn't just about growth or military dominance, it was about institutional consistency. You could price risk because the framework was stable. This week, investors were forced to ask, is that stability still intact?
And the bond market seems to be the pressure valve for all of this.
Exactly. The U.S. 10-year yield hovered around 4%. On the surface, that reflects moderating inflation and growth expectations. But beneath the surface, I think duration looks underpriced. The real issue isn't just inflation arithmetic, it's term premium. If deficits expand, if issuance increases, if policy volatility rises, investors demand greater compensation to lock money away for 10 years. For years, the term premium was suppressed by central bank buying, regulatory demand, and foreign reserve accumulation. That bedrock is less certain now. Foreign official buying has slowed. Central banks aren't absorbing supply like they once did. And importantly, the composition of demand is shifting. Retail participation in treasuries has grown steadily since 2021. It's still a minority share, but the marginal buyer matters. Retail capital is more yield sensitive, more flow driven, more reactive to volatility. That doesn't mean instability is inevitable, but it does mean the old stability premium attached to duration isn't as secure as it once was. In a world of fiscal expansion and geopolitical fragmentation, 4% may not be enough compensation.
You mentioned volatility tied to retail behavior. Blue Owl was a good example of that this week.
Yes, and this is an important story. Blue Owl's situation isn't about credit quality imploding, it's about structure. For a decade, the industry has promoted the democratization of alternatives, opening private credit and private equity to wealth channels through semi-liquid, evergreen vehicles. The intention is understandable. Why should only institutions access the illiquidity premium? But illiquid assets require illiquid capital. Full stop. Evergreen funds offer periodic liquidity against assets that cannot be sold quickly. That structure works beautifully in calm markets with steady inflows. It becomes fragile when flows slow. We've seen this before. UK property funds after Brexit. Liability-driven investment strategies in 2022. Structures don't fail in the middle of the cycle. They fail at the margin. Private credit has grown from $500 billion a decade ago to over $2 trillion today. Distribution has shifted heavily into wealth channels. That changes behavior. When retail becomes a meaningful marginal participant in traditionally institutional markets, volatility increases, not because the assets are flawed, but because the liquidity assumptions are. Markets discipline excess faster than regulators. And when discipline arrives, narratives change quickly. Stepping back from the US, how does the global picture look? Interestingly, relatively stable. Economic data this week were mixed, but not alarming. In the US, the leading economic index remains slightly negative, consistent with slow growth, not recession. The Philly Fed survey surprised to the upside. Industrial production beat expectations. That tells you the industrial cycle is healing quietly. Japan reported blowout core machinery orders, a reminder that capex cycles globally are not dead. Australia delivered strong labor data. The unemployment rate fell to 4.1%. That's not recessionary, that's full employment. So here's the contrast. The macro data are broadly constructive, but institutional volatility in the US is shaping global risk premia. That's an important distinction.
And what about emerging markets?
Emerging markets may benefit from this shift in psychology. It's not that global conditions are perfect. It's that the relative risk premium on US assets is no longer compressing the way it did for years. We're seeing EM central banks easing ahead of developed markets. The Philippines cut rates. Korea and Thailand may lean dovish. Latin America growth is expected to re-accelerate. EM debt spreads have tightened meaningfully. EM equities have rallied. That momentum could continue, particularly if the dollar softens. When U.S. institutional credibility is questioned at the margin, capital looks for alternatives. It doesn't need perfection. It needs relative stability.
That's it for this week. Stay tuned for more insights next time.